Hey, thanks for being here today. I'm really excited you could be here. So today we're talking about investing in real estate, but we're talking about investing in real estate in a new and interesting way that you've probably never heard of before. And we found the guy that figured out this really obscure way and is now building an empire using this method to be able to invest into real estate. So if you ever were to break into real estate investing or you ever want to take your real estate investing to a next level, well, you're going to love this episode. So we've got a lot to cover. Let's get started. So I want to introduce you to Matt Porcaro. Excuse me, Matt. Just slaughtered your name. That's how
It's
we
an ear.
start.
It's a mouthful. Porcaro.
That's
Yep.
how we like start the show. So after 4 years of trial and error with various different strategies to break into real estate investing himself, Matt actually discovered a little known government-backed renovation loan that allowed him to purchase and renovate a duplex and with only a small out-of-pocket investment. Now, using the strategy, he turned a modest $9,500 down payment into $130,000 in liquid equity and a couple $1,000s a month in passive cash flow, all in just 8 months' time. Now, after repetitively being asked by friends and family how he did it, he decided to actually create his own community focused on leveraging this loan and developing a strategy he named the 203K way. Now, since then, he's helped hundreds of aspiring investors acquire their first or next cash flowing high equity investment property with only a 3.5% down payment, all by utilizing this unique loan product. But it doesn't stop there. The first 203K deal not only helps his students achieve immediate equity and cash flow, but also serves as a springboard to even more opportunities, helping them launch successful real estate investment careers, just like it did for Matt. So, Matt, thanks for joining us today.
Ty, thanks for having me, man. Great intro. I feel good. Hopefully, I could live up to the hype.
Well, I'm really excited you could be here because, we help a lot of real estate investors invest in real estate. And I've never heard of this before. And I think a lot of people watching haven't as well. And that's one of the big reasons we wanted to have you on the show. So let's start there. Like, what is this 203K loan?
Yeah. So again, it's not uncommon for people not to hear about it. And what's crazy about it is that it's a federally backed loan. It's actually a derivative of something that maybe you have heard of, which is the FHA loan, which is the Federal Housing Administration's loan product to help more home buyers get into their first home or their next home or whatever home they're planning to buy and occupy. The 203K version is a specific version of the loan that you get all the benefits of the regular FHA, which is low down payment, right? We just talked about 3.5% down. You get a lower interest rate, so you get all the benefits of that. But what's really cool about this program is that it not only gives you all the money to purchase the house, but it gives you all the money to renovate the house. And all you need to put down is just that 3.5% down. So when you kind of look at the real estate market and, if you're struggling to find real estate right now, as a lot of people are, right? You know how a lot of first-time home buyers, even investors, they all are struggling to find housing right now. And especially if you're a first-time home buyer, your inventory is very limited. So what this enables a lot of people to do is open their inventories widely, because now you can go after those fixer-upper houses that only cash investors typically could have bought in, or those properties that were in complete as-is condition, or a foreclosure home, or an as-is property. So it just gives people, especially that are just starting out, a huge leg up, because you're basically playing with a tool that, number one, nobody knows about, but number two, which is extremely, extremely powerful. Like when you talked about like how I built equity and everything like that, that's really where it made a huge deal for me, was leveraging this to really springboard myself into being a real estate investor, into all the benefits of real estate investing, which I'm benefiting from now.
So when you say government loans, right? When we relate this to FHA, immediately people
Mm-hmm.
think about the difficulty of doing a lot of things with the government. So that being said, is the 203, is this 203K loan, is it hard to do? And what can investors do to kind of streamline the process so it's not difficult for them to navigate through?
It's a great question, and I think one of the reasons why a lot of people don't talk about. Well, I know one of the reasons that a lot of people don't talk about, and I've thought about this a lot over the years because it's eaten me up. Because I know when I did this first one, it blew me away why it took me so long to find it. As you mentioned, like I was trying to get into real estate for 4 years. I'm here in New York. New York is an extremely high cost, very competitive very densely populated area. So me as just kind of a new guy at the time into the housing market, into the job world, I was wondering how I would ever be able to afford anything in New York, let alone an investment property or something like that. So to answer your question, the reason why, number one, people think it's hard or anything like that is because lenders and real estate agents theoretically are really the only people that would know about this, right? Your average consumer is not going to know about a program like this. It's a very specific program. It doesn't have any like FHA doesn't market their programs, right? The lenders and the realtors are supposed to. But realtors and lenders don't want to market it because they do look at it as being extra work. Why? Because yes, there's the additional aspect of not only are they giving the money to purchase, they're giving you all the money to renovate. So as you could assume, if they're going to give you all that power and all that leverage, they're going to ask for more stuff. The problem is that for them is that it doesn't benefit them any. So if they do that loan, they make their same commission, right? If they do that, like nothing changes for them. So they hold it back. So they see it. Your question was, is it hard? My response to this always is have you ever played golf before? Are you like a golf player or by any means or
I'm not a golf player, but I have
okay.
definitely tried. I think everything I know about golfing, I've learned from Top Golf.
Okay, excellent. So perfect example, right? The first time you ever swung a club or you went out, let's just say you went out for a golf course and you played 18 holes, given your current, situation. Now you go play 18 holes. Are you going to score very well? Probably not, unless you're
No,
kind of a phenom,
I don't even
right?
think I have enough balls available to make it through 18. That's how bad
Yeah.
it would be.
Now, and it's probably going to be not fun for a lot of it. You're going to be frustrated. You're going to be hitting the ball. You're going to be hitting other people, all this type of stuff. And you're going to get done. And then you're going to say, man, are you going to say golf sucks? Or are you going to say that you suck? Right now, the game, what I'm saying is the game of golf isn't bad, right? It's that the player doesn't understand the game or isn't good at the game. The 203K loan is the same way. The fact that when people say it's hard, the people that say it's hard are just people that have never done it. It's like, or they've done it once and they don't understand it. Like anything else, it needs to be done by someone that's experienced with it. So, um, at the end of the day, it comes down to a couple things. The added stuff that they ask for is number one, they are asking you for a clear scope of work of everything that needs to be done to the property. So the way the process, and if you're cool with it, I'll just go into like how it works.
I'd love to.
So basically, yeah. So basically, what happens is, you find a house. Say you find a fixer-upper house on the MLS or in the market, and maybe it's a foreclosure property, and it's really beat up, right? But it's in a neighborhood you really, really want, and usually these fixer-uppers and these as-is properties are priced under what retail or something in brand new condition would be. So you go in, you place an offer on the property, maybe at that price or whatever it is, and then you get it hopefully under contract or close to contract. Then what happens is instead of getting a home inspection like you typically would get, if you were going to buy a house, regularly, you're going to get what we call a 203K HUD consultant inspection. And the 203K HUD consultant they're usually just home inspectors that have this certification as well. You can go online, you find them very easily. And they go in, and what they do is they do a home inspection, but more importantly, they create a scope of work of what needs to be done with the property, as well as anything that you'd like to get done with the property. So they create a very clear scope of work. Okay. Now, from there, you take that scope of work and then you go find contractors that could do the work. Now, they require licensed and insured contractors. People, for some reason, like contest this with me. I don't really understand why. I was in the construction industry for 10 years. I don't know why you would ever use anybody that wasn't licensed and insured. But I guess people like to find out the hard way. But you have to find a licensed and insured contractor. That's it. There's a common misconception that they need to be 203K certified or anything like that. That's all just not true. Anyone that's licensed and insured and has some experience can qualify. And then that contractor will come up with the budget of what that renovation is going to be. Once they come up with that budget, that gets sent to the bank. The bank adds that to your total amount. So you have, let's just say you bought you're purchasing a property for 200,000 and you're putting $100,000 worth of work into it. So your total loan amount would be $300,000. Now you only have to pay 3.5% of that $300,000. So in that case, I'm really bad at quick math, but somewhere in the neighborhood of like, I don't know, $12,000, $11,000, something like that. That's all you need to do to put down. So you put that down, and then you go to closing. The seller gets paid the $200,000 you got agreed upon, and then that $100,000 goes into an escrow account. And then as your contractor completes the job, they get paid out in draws, just like it would on like any other really kind of renovation project or insurance job or, hard money lending type of scenario. And that's the way it works. So again, the added thing on it is like, yeah, you have to have that. People say, oh, there's too much paperwork. There's not too much paperwork. There's exactly as much paperwork as there needs to be, which is a clear scope of work, which you should be doing every renovation that way, no, regardless. And second off, a contractor resume just stating that they are legitimate and they are licensed and they are insured, and there's someone that's warranted to get this $100,000 that's going to be implemented into your property.
Right. And what you're describing is very similar to, like you said, to fix and flip loans. It's very similar, not money
Exactly.
down, a lot less money down, but
Oh
it's
yeah.
also similar to, a construction or perm
It
loans, right?
works
So
it works exactly. I wouldn't say exactly the same, but structurally 100%. And what's cool too, the difference between hard money and like those contractor loans are typically in those, I mean, because I'm a flipper myself and I've done those, and it's typically like you lay out the money with the contractor and then the contractor gets reimbursed later. In this case, the check gets written out to you and the contractor. So you co-sign. So they get paid they get paid directly by the bank. You get the inspection, the contractor gets paid directly. It makes it very simple for the contractor, and it's guaranteed money for the contractor. That money is in an escrow account waiting for them to be paid. So, if anyone, another, point of contention people say is like, oh, contractors aren't going to want to do this. Yeah, the wrong ones aren't going to want to do that, right? Because they know if you've ever done insurance work before, commercial work before, this is literally how it's all done. It's done in draws for this reason to protect not only you, but the borrower, the bank, and the contractor as well.
so what are the loan limits? What's the minimum? What's the maximum loan we can get?
Yeah, great question. So the easiest way to look this up is literally just Google FHA loan limits in your market. I know, so New York's a high cost of living state. So in like New York, your total loan limit's like 1.1 million or something like that for a single family, and then it goes up to like 2.4 for a four family. Um, so but then like in places like Texas or Florida, I think it's like 5 or 600,000. Basically, it's 110% of whatever the median sale price is, or 120% of whatever the median sale price is in the market. But the best way to do is just Google it. And then the FHA loan limit, people tend to ask this question. That's the total loan amount that you're given. So in this case, with the 203K, your total loan amount is going to be whatever your purchase price is plus that renovation budget. So both numbers have to fit within that loan amount in order to get all of it financed.
Right, which is normal and kind of almost a safeguard for you as the investor because it makes sure that you're buying the property right so you can actually exit and make your return.
Well, right, exactly. So what that's another part to the bank, right? So what the bank wants to know is they want to make sure also that, this property is worth it, right? Very similar to a DSCR loan or something like that. Like it has to appraise. Now, what's crazy about the 203K, as much as I don't condone it, but it is a crazy thing that it allows you to do because this is an owner occupant loan, right? Now you have to remember, right? This could be for your Harry and Sally homebuyer that are just looking to buy their first home. They're looking in an area they can't afford something move-in ready, so they look for a fixer-upper. They get all the money to renovate it. They get something exactly that they want, and then they live happily ever after. They're not doing it specifically to build equity or try to produce cash flow through house hacking or something like that. But if you want to do it smart, use the bank's money to get all the equity, right? On my first deal, I only put $9,500 down. It was a duplex property. That's another cool thing about these 203K loans and these owner occupant renovation loans is they allow you to buy up to a 4-unit property. So if you're familiar with the house hacking concept, right, it's really popular right now, especially with like the new 8 accessory dwelling unit stuff, where basically you're adding an accessory unit or implementing an accessory unit in your home, like a mother-daughter suite, that type of thing. Because with interest rates right now and all these things, like people are like, how do I afford these houses? Well, you buy a house, you rent out a portion of it to, in a good case, like maybe a friend or a family member or something like that to help lower the burden of the cost of the mortgage. But in a great case, you buy something that's a good fixer upper and you build a lot of equity into it and a lot of value, and you get a really great unit in there. And you can, in many cases, like in my case, I was only kicking in like $100 or $200 a month. So I got that $9,500. I got that 150,000 in equity, but I was also living for free. I was living in one unit for a brief time. Was renting out the other unit. Again, I was maybe virtually for free. I was putting in a couple $100 a month, but then I had moved out, and that thing still cash flows me $2,000 a month since I moved out after a year later. Um, so anyway, the whole cool benefit of this is that you're able to take this and increase the equity. Now, again, one of the coolest things about it is that you can over leverage yourself. Now, again, this isn't cool if you're trying to be a real estate investor, but they actually allow 110% loan to value of the after renovated value. So if you think about that for a second, if you know what that means, if the property will be worth 500,000 when you're done, they'll actually give you a loan of 550,000. So they'll let you over leverage it. Now, I don't advise this, and I'm not saying that that's a good thing to do, but for people in these scenarios where maybe you want to wrap in all your closing costs, which we do a lot, or there's a new thing that's been built into the program as well, they know that if this is going to be your primary residence, that if you're currently renting and then you're going to be buying this house, how are you going to pay for your rent, and how are you going to be able to make the mortgage payments when your property is being completely renovated, right? They thought about that. They allowed you previously, actually, as of this week, this changed, which is wild. But previous to this, they would allow you to wrap up to 6 months mortgage payments into the loan as well. So what you do is you buy a house, you put down your, in our example before, you put down your $11,000. You get into the property, you can wrap in the first couple months mortgage payments into the loan. Now it adds to the loan amount, but it's not money you have to pay out of pocket. You can continue renting where you're at, get your house renovated, and then when you're ready, you can move in. Now they've actually, as of this week, they've just extended it to 12 months. So you can actually buy a house, do the full renovation on it, but put the down payment down, not have to pay out of pocket for that house for up to 12 months, then move in and again get all the benefits of appreciation and the forced equity and a brand new house to live in. Like that over leveraging concept could really help a lot of people. Now, the idea is you want to do your work to your property, you want to build some equity in it. But for the people, like for any first time home buyer right now, it's a huge game changer. It helps you on closing costs, and it helps you on the ability to like not having to pay for it while you're renovating it. It keeps so much more money in your pocket.
You mentioned DSCR, and there's a ton of unique benefits, I think, to what you said. The 110% rolling in your closing costs, rolling in payments for 6 months, going through a rehab process and then have to pay for months after. You,
Yeah.
you mentioned DSCR, and DSCR requires triple the money down, but it's also stated income. So I imagine since this is kind of like a similar to an FHA product, is it full documentation? I mean, and DSCR requires really good credit, but FHA loans don't. So like what are the kind of debt to ratio requirements here? Is it full doc? Like what's the credit score requirements? Give me an idea of qualification.
Yeah, so it is a doc loan, right? So the reason they give you very low down payment, right? When you do the comparative of like a DSCR is like 20% down minimum. They don't give you the money for renovation typically. It's an asset-based lending. This is not an asset-based lending. Hence the reason why they give you such good, guidelines or good, requirements. The requirements are 580 credit score minimum. Now I will say that's what the guidelines say. Banks will not really want to look at you until you're probably in the 620s. So 580 credit score, but likely 620 minimum. 2 years of consistent income. W-2 is preferred in many cases. However, if you show and you produce income and you can show that on your tax, they can only approve you based on what you show, right? As you said, like it's not stated income. This is what's different. Pluses and minuses to each product, obviously. So you have that. And then the debt to income ratio, it's really around 50%, like give or take a couple percentage points based on the deal, based on your credit. There's a lot of different things there. But for all intents and purposes, like FHA products are literally the lowest hanging fruit mortgage product in honestly the world. I mean, I've had people that reach out to me from overseas asking if they could do this product. And I'm like, and I had a guy recently like called me, like found my number somewhere, called me. He's from Norway. He's like, I really want to do this, man. How do I do this? And I'm like, are you like a citizen in America? He's like, no. I was like, he's like, dang, man, America always has all the good real estate stuff. We have none of that stuff here. So it's like literally when you think about it, it is the most powerful form of home buying leverage in the world. And again, it's because of the fact that there's a lot of stability in the single family housing market and like, the owner occupancy housing market. So those are the guidelines. And again, that's where it comes in. Now, the cool thing about it too, now the house hacking concept, and I think this is a really important point, especially with this is going, very crazy lately, is they're able to forecast the future rental income of those other units. So when you look at debt to income ratio, maybe right now you work a decent job, but you're looking to buy, you're in Tampa, I'm in Long Island, like people could still be making good money where they're at. And like, they still feel like they can't qualify for a loan between rates and between home values and everything like that. If you are renting out or you plan to rent out another portion of your property or the other unit in your property, an accessory unit, they're able to forecast that future rental income of that other unit. And typically it's roughly, it depends on the market, obviously, but we're looking at roughly for every $1,500 a month you're able to connect or collect from a unit, that'll increase your buying power about $80,000 to $100,000. So a great tool with this is when you implement this house hacking concept, or you leverage this ability that they're making it easier for first time home buyers. They're just saying, hey, listen, you're going to help us solve the housing problem, which is a big problem right now. You have a lot of people looking for a place to live. So you're going to provide affordable housing to people. And in addition to that, you're going to get the money and you're going to be able to lessen the financial burden on yourself. Plus, you're going to get all the tax benefits and all that stuff of really being a landlord and everything like that. But more importantly, it's going to give you a leg up in this environment where you can afford more, where you felt like maybe you were priced out of the market that you wanted to live in. Now you can stretch yourself to afford more comfortably and safely by renting out the tenant and survive, solving a really big problem in the market right now.
Matt, can I have more than one of these loans?
So it's a lot of stuff has changed in the last year. So if you asked me about a year ago, the answer would be no. You can only do one there. You can only have one FHA loan under your name at any given time. And that's like people's number one question. I was just talking to a guy earlier today and he's like, how many times can I do this? I'm like, let's just do it once and we'll see what doors open with us. But up until recently, the FHA was the only loan where you could buy a multifamily property and get all the money to renovate it. But you can only do it once, or you can only keep it under your name. Now you could refinance out of FHA, go move to another property, and then get another FHA loan. If you can't have the FHA product under your credit score at any given time. However, the game has changed. There's other government programs out there that act the exact same way. The Fannie Mae home style loan. I'm actually doing it on my own house right now. I'm doing it on my forever home right now. It enacts the same way, but as of a couple months ago, they actually added the ability to also, it used to be that FHA was the only program that allowed you to buy up to a 4-unit property. Fannie Mae now is now allowing you to buy up to a 4-unit property as well. They're just requiring 5% down instead of 3.5%. But you can do that. You can buy a property with an accessory unit, but Fannie Mae doesn't have that limit. Well, Fannie Mae's limit is actually 11. So you could do this up to 11 times if you really wanted to move. Now, the whole caveat is you have to move into the property, but we talk it like flip hacking to wealth, right? You're flip and house hacking your way into more and more properties and building a portfolio with very little down payment each time. If you have the patience and the ability to constantly move around, it's a great way to do it. So that's a huge new thing that changed literally in the last year. That's kind of what we're seeing right now with people that want to repeat this.
So we all have heard of the Burr method, like the buy, your rehab,
Mhm.
your rent, your refinance, repeat, some order of that. So those are really meant, and if we look at normal hard equity loans for real estate purposes, they're bridge loans, right? They're really just designed to get you in, get you out, and then you get into a regular mortgage. What
Yeah.
do you think about these 203Ks? Are they really meant to stay in long term, or are they more designed as bridge loans to get you in to refinance into another product and move on?
So that's a great question. And the surface level answer is they're meant to be longer term. They're 30-year fixed rate mortgages, right? However, what I will say is that the way I teach it and the way that I tell people to leverage this is to get out of the FHA as quickly as you can for multitude of different reasons. Maybe if you ever want to do it again one day, number one. But number two, and probably more importantly, is to get rid of the mortgage insurance. So one of the I wouldn't call it a downside, but let's just call it a downside for the sake of me keeping it simple. One of the downsides of putting 3.5% down is that you have to pay mortgage insurance. So mortgage insurance is basically the whole reason FHA operates, right? What they say is they say to these banks, hey, listen, we're going to insure, because FHA is not, they're actually not lending you the money. They're insuring the money that other banks lend you. That's really theoretically, we're going a little deep in the weeds here, but that's really theoretically what it is. So in order to be part of that FHA club, you got to pay your little FHA VIG in the form of mortgage insurance. And basically everybody that puts down less than 20% down and uses an FHA loan, in order to be in the FHA club, you're paying a mortgage insurance for every year or on every one of your payments. It's usually a couple $100. It's like 1.5% of the total loan amount over each year, but it equates to roughly a couple $100 a month. Um, what happens is when you close on this loan, you're going to get that mortgage insurance. Now, in my case, I wanted to make that property a rental. So I knew that I wanted to refinance out and get rid of that mortgage insurance. I wanted to build enough equity to refi into a conventional without mortgage insurance so that I could save my money and actually get a little bit of a better rate. So, because the rates are really about the same on FHA and 203K and everything. Like, even people think it's like a higher cost. It's really not. Um, but you want to get rid of that mortgage insurance. So I tell people, like, try to build at least 20% equity into the property. That way, when you're done with the renovation, you can immediately refinance out and lower that mortgage payment a couple $100 a month, and also open up the ability and the possibility to go do an FHA again sometime.
What advice do you have for somebody finding the right property? Because this is very much about finding the property that
Oh
is
yeah.
at the right value and that you could put the money in to be able to get a higher value when it's done. Well, what advice do you have for somebody just starting out to be able to figure out how to kind of find the right property to invest in?
So here's what's really cool about this product. Okay. What's really cool about this product is that you are fighting a different fight than everybody else. I call it the Goldilocks zone. Okay. So you have the bulk of the market, right? You have your retail home buyer market, right? That's your, again, I call them the Harry Sally home buyer. They're just looking to buy anything. Um, they're looking at move-in ready homes. They go to the open houses. There's 1,000 people there, that type of thing. They're all competing for the same stuff. And that's one world, but it has to be move-in ready and everything like that. Then you have at the other side, you have your wholesalers, your flippers, your investors that are looking for stuff at really deep discounts, right? They're usually looking for off-market deals and stuff like that. Now, I don't know, I know we talked a little bit, but I don't know if you're an active flipper investor, but I know as a flipper, like the stuff that's listed on the market, like on the MLS, that's like fixer upper or as is or anything like that, the pricing they're putting it up at would never work for me because I have so much more cost, right? I have holding costs. I have like double closing. I have cost of capital. I have all this stuff, right? Plus I have to make a profit at the end of it. I have to flip it. So the stuff that's listed on the market is like usually just like priced way too high for me to actually make a profit on it. However, it's perfect for someone that's using one of these owner occupant loans because their financing is so much cheaper. Their cost of capital is so much cheaper. And they're also intending on living in it, and it's also going to become their place to live. So, what I tell people is like the stuff that's on the MLS is really like already sitting there for you. Now, of course, there's still going to be competition. And in a lot of cases, you'll still have competition with cash buyers. You have investors that are getting a little overzealous and stuff like that. But what's great about this is like I call it having the right bait with the right tools. Like the 203K is the bait. You're bringing in the ability to buy a property as is condition, wrap in all the closing costs, basically waive the appraisal contingency, not have to worry about inspection, all those things. Plus, you're able to probably afford more than a cash investor because you have less out of pocket, less cost of capital, all those other things. So you can just surf in that Goldilocks zone. And I tell people just go and look for anything, like literally go on MLS, go on Zillow, look for the type of property you're looking for in the area that you're looking for, and sort it by just like lowest price to highest price. And anything that's priced low is typically going to be something that's distressed or as is or foreclosure or short sale or whatever, and offer on all of it. And just offer at numbers that would make it work, where you could build 20 to 10 to 20% of equity and just play that numbers game. Because again, you are going to be on average over time, you are going to have a better edge than your other competition, which is not the retail buyer. You're not fishing with the retail buyers. They're not even in your game. Your only competition is really like the flippers. And again, flippers are very fleety. One really, really awesome tactic that has worked tremendously well for us, and this could probably work for anything, but I found that this has worked really, really well for people in my community. And this is such a ninja hack, and it's so easy and it's so simple, and nobody thinks about it or does it, but it works tremendously well. Is they look at these properties and they look on the MLS and they look for stuff, and they're just looking for stuff that's on market, and they're placing offers on what's on market. I can tell you from experience as a flipper, the most vulnerable time for me as a seller is if I was under contract and fell out of contract. That timing is when I am willing to take and entertain any offer, even if it's 20, 30, $40,000 lower than what? Because again, I deal with cost of capital. Every day that thing's on the market, I am losing money, right? I need to get that thing moved. I have to pay back my investors. I am on a crunch. So what happens is I tell people the best thing to do is go and don't limit your search to active. Look at pending. Look at stuff that's under contract that fits your criteria. Call the listing agent, say, hey, I'm really interested in this. Hopefully it closes for your sake. But if anything changes, please let me know. I'm very interested in this property. I'm an owner occupant, so I'm a very serious buyer. And I'll tell you right now, the fleetiest buyer, when people say like cash is the best offer, I totally disagree. Cash buyer from a seller's side, I've seen cash buyers are the fleetiest buyers out there because they're not looking at, there's no emotional connection to the deal. If there's something even remotely weird about it, or they see another deal that's better, they're going to pull out and just bounce. They don't have any attachment to the property. So if you have something, they're like, oh, we have a cash buyer, cool, still go in as a backup offer, because that cash buyer might not perform, or their back end investor doesn't like the deal. They'll back out. Then that seller's really in a pain, but that real estate agent is going to feel like a hero, be like, listen, I got just the person for you. They can buy it. They're a retail buyer, so they're more committed. They're going to live in this neighborhood. They care about the area. They're way more committed of a buyer, and you could swoop in and typically get something at a discount.
Great advice today, Matt. What is something I should have asked you but didn't that can help somebody avoid the mistakes and have success with a 203K loan?
Man, I think the biggest thing is working with the right lender. So I am not a lender. I'm not a real estate agent. People ask me like what, well, like what, I'm just a guy that knew there had to be a better way to get into real estate investing. I found this and just don't understand why no more people don't talk about it. It's like a travesty to me. I really think it's a huge issue. So I don't like, I've always just told people like, you have to take advantage of this program, use the right lender. And I always told people use the right lender, everything like that. Um, Over the years, I've worked with different lenders, and I've partnered with a couple. Shameless plug, the 203kway.com/lender. That puts you connected with my lender network, my lender partner network, these lenders that I'm partnered with that are vetted, that understand this product very well, and they can do it anywhere in the US. Um, that is the key. If you work with a lender that doesn't know how this works, like the golf analogy, right? Like like, I don't want the guy that plays once a month with his buddies. I want Tiger Woods to run and you have lenders out there that are the Tiger Woods of renovation loans. They've seen it all. They specialize in this. They're very niche. There's not many of them, but the few ones that do, they do it and they do it well. And I'm connected with them. So it's really having the right lender. If you don't have the right lender, I'd say that's the biggest thing. The second and most important thing I would say is just making sure that you have the clearest scope of work imaginable. And this is not just for 203Ks. If you're listening to this and like you don't see yourself doing a 203K, but you see yourself as a flipper or a real estate investor. My background is in construction. I worked corporate construction for 15 years in New York City, as my corporate job before I went into real estate full time. And there was not a single project that I ever did, large or small, that ever did not have a very clear line item scope of work and a schedule. If you are trying to do construction without a clear line item schedule, scope of work, and a schedule, and even really, it's crazy that I even need to say this, but a contract that's signed. I mean, they're called contractors for a reason. You have to be in contract with them. If you don't have those three things, you'll never succeed on a renovation. You never will. This luckily forces you to do it, but you want to make sure that that's dialed in as many, like if there's any nuance in there, make sure that you put it down on paper, because you have to live and die by that. That scope of work becomes your Bible, and that's going to, as a buyer, going to save you tremendously on, contractors coming back to try to beat you up on price, try to get you more money out of them, or trying to change the scope under your feet. The clearer you get, the stronger your position is going to be, and the more likely that your renovation is going to go smooth.
Great advice, Matt. Where can everybody watching that's interested in learning more and getting started go?
Sure. So I always said that, like, I'm an open book. My goal with this, when I first started talking about that, I never thought, number one, I never thought this would turn into anything. I just like started talking about it, and people became interested in it, and it kind of grew over time. I never expected this to turn into a community and everything like that. It all started on Instagram. So you can find me on Instagram at the 203K way. You could probably just type in 203K in the search and you'll find me. That's the first thing. The other thing is I have a free community just dedicated to helping home buyers, people that are interested in using this product, just an open format discussion. It's a Facebook community. You just look up on Facebook groups, facebook.com/groups/the 203K way. It's free to join. You just jump in, and I have a lot of guides and training in there and all free stuff. I don't try to hold anything back. I just want to give people the ability to take advantage of this. And again, I think one of the other things I tell people is, like, this might not be for everybody. And I know it's not, right? There may be people listening right now that, they already have done 8 deals and they have 8 properties and they live in a beautiful house in the suburbs. Like, this probably isn't for them. But I can guarantee that someone else in their family is looking to buy a house right now. Someone else, or is going to be buying a house in the next, couple of years. This, like, for anyone that's looking to buy their primary residence, this is a no-brainer. There's no reason not to. It is the cheapest money on the planet. It gives you the ability to create equity, basically get like infinite returns on your money when you look at this at a long time domain with such little out of pocket. I think everyone needs to utilize it. And, so if you're looking at this and you're thinking maybe this, isn't exactly for you, think of who in your life could probably benefit from this right now, especially in such a tough market, that we're seeing right now.
I love it. Thanks, Matt. Thanks for coming on with us today.
Ty, thank you, man.
All right, so listen, if you're watching this, we talk about real estate investing a lot. A lot of you are real estate investors, or you're getting into this if you're not already. And this is probably one of the most make sense, extra benefit, low down payment products that we've ever talked about before. But we just scratched the surface. So make sure you go to the203kway.com. That's the word the 203, which is the number 203 kway.com. When you go to Matt's page at the top, you'll be able to access this blog. You'll be able to access more about the program. You'll be able to access case studies to actually see real success stories. But you're also able to scroll down on this page. You're able to get even more access to his social media page. You're able to click in one place and get access to his actual community there as well. He's got a 1-hour masterclass that dives in way deeper than what we've been able to today. He has even got a free cheat sheet there. And on top of that, he's got his lender's directory there. So, I mean, everything you need to get started, including the community, the training, everything to learn more about getting started is all at the203kway.com. So make sure you check it out right now, the203kway.com. And while you're there, follow him on social, follow him on Instagram. You can also access his YouTube and his other social there as well. So make sure you check it out, the203kway.com. Thanks for tuning in. Have a great day.